to all the clients of Nesher Investments or Nesher Management Services, which is the asset management side of a business. A warm welcome this afternoon. We're really glad that you can join us. We are recording this session as well, so we'll send it out to you afterwards in case there's anything missed. We're going to run this as a webinar, so unfortunately no questions during the session, but you're obviously more than welcome to send any kind of questions you have relating to the session to the Nesher team, Hercules and Megan and Bertie, afterwards, and we'll try to cover all those questions as far as possible. Joining us now, we welcome Jacobus Lakok, Portfolio Manager and Strategist at Fairtree Asset Management. Maybe just for our audience out there, for those of you that are maybe not familiar with Fairtree, because it sounds like a strange name, but Fairtree is an asset management business that's been going since 2003. They launched in the hedge fund space, so they manage a range of hedge funds for which they've also won numerous awards through time. And they also launched their SA operations with equity long-short funds, fixed income funds, global credit funds, and it's one of the fund managers that are very prominent in the NMS model portfolio range. So we employ them as one of the underlying fund managers. Maybe you haven't seen the name Fairtree. It's because they manage mandates like the Select BCI Balanced and Cautious Fund for us. And they also manage the BCI Income Plus Fund, which is a global credit fund, which you'll find in the NMS income portfolio. And they've subsequently done extremely well through 2022, which was a tough year for all, but exceptional returns that came through in January. It's a bit of a sigh of relief for all investors out there. Hercules asked us to chat to you today a little bit to give you a bit more background on what's happening in SA and the global macro backdrop. Are we in for another tough year or not? Unfortunately, I can't tell you what you're going to make during the year. I wish I could. But like I said, joining us from Fairtree is Jacobus Lakok, who is one of the strategists and also portfolio manager, to give you a bit of an overview or insight to their thinking and how a lot of this comes together using the Select BCI Balance Fund as example and how they apply that thinking in the fund. Jacobus, again from our side, thank you so much for your time so late in the afternoon. I know you're extremely busy, so we're really thankful for your time.
Thank you, Gene, and thank you for the opportunity. So I'm just going to share my slide pack here with you, and if you can just confirm that you are seeing the slideshow.
It is coming through. I can see your slides.
I can see it as well.
Presentation mode, absolutely perfect. Thank you.
Perfect. Thank you so much for that. And yes, so I'm a fixed income portfolio manager and our macro strategist. So my job really is to look at the macro environment and then inform portfolio managers across the business with what I think is important to focus on, where the world may be moving, and then from there, almost like providing the input to the top-down process for our PMs. So I'll take you through our macro view for 2023, and then I'll spend some time also on the balance funds performance very briefly. In terms of our macro outlook, and as I said, keep some questions maybe towards the end, and we can tackle them then. But in terms of our outlook, the four variables, or the summary of the four variables, which I think will be key this year, is dotted down here against also what the expectations of the market is. So in red, you will see where we are different or where we disagree with the market. But our own views are as follows. A short summary. We believe inflation has peaked or is in the process of peaking in developed markets and will fall sharply over the first half of this year. But where the market believes that inflation will go back to the central bank's target, so that 2% level, we disagree. We think that it will be difficult for central banks to contain inflation at those levels. Secondly, central banks have been quite hawkish over the last year. They will remain hawkish throughout the first half of this year. They will potentially tone down the amount of hikes or the pace of hikes and ultimately start to pause potentially sometime later this year, towards the end of the first half of this year. But where the market thinks that there will be, or believe that there will be cuts starting from the second half of this year, from about Q4 this year, we disagree that there isn't a lot of scope for central banks to cut rates significantly. The market is pricing in that rates will go to, I think, 3% by the end of next year. We think, given the inflationary pressures that we're still facing, that will be a difficult task. On the growth front, we do think that growth is slowing, and we think that growth will ultimately fall in developed markets into a shallow recessionary environment. Whereas at the moment, what we see is that consensus are starting to build this view that we're heading for soft landing. Soft landing meaning that we're getting below trend growth, but still positive growth. We think that the negative impact from the rate hiking cycle last year, which is still ongoing this year, will still impact tight financial conditions. Also, the very high cost of living which we experience, and some markets are still experiencing, will still have an impact on growth. But some of that would be offset by a strong consumer in the US, lower energy costs, which we're now seeing, as well as China that's starting to reopen. So that's why we're going for a soft, or not a soft landing, a shallow recession rather than a deep recession. And we think that the risks to that growth weakness sits in the first half of this year relative to the second half of the year. In terms of geopolitics, we're still seeing an ongoing war between Russia and Ukraine, and we're still experiencing, after some easing of tension between the US and China, over the last few days, we see that those tensions have increased again, and we believe that will remain in the background for years to come. And so that will continue to provide a very uncertain geopolitical backdrop. And then for this year, in particular in the US, we'll also have the debt ceiling that has to be handled towards the second half of the year. We think that can bring some additional political risks onto the foreground. So a lot of uncertainty, and I think overall still what we view as a stagflationary environment. So developed markets we see are slowing as they're still fighting those shocks from last year, an interest rate shock, an inflation shock, as well as the geopolitical shock. Whereas in China, we're seeing a reopening taking place, not just a reopening, but also we're seeing policy easing starting to shape up. And so if you look at the growth forecast by the market, you will see the only region that is expected to grow this year relative to last year at a faster pace is China. We think that the US still face some downside. So relative to consensus, we are more negative on the US. We're more positive than consensus on China. And we are relatively similar to consensus on Europe and South Africa. Maybe I would say the risks to South Africa sits to the downside. So, I would expect that given the load shedding issues that we're facing, the growth could be slower than the 1.3% there. And in Europe, we could potentially see a slightly better outcome there. So in terms of then this divergence in growth between the US or developed markets and emerging markets, we also see that coming through in the PMIs. The PMIs are essentially a survey, a forward-looking survey that follows the cycle or leads the cycle by about 6 months or so. You can see even from here that emerging market growth, the outlook has improved relative to developed markets. So remember, most of these emerging markets are mostly or more tied towards China. So as China is reopening, providing some input or boost to commodity prices, and also, as a result, seeing some weaker dollar, this will support emerging markets. Whereas in developed markets, the inflation problem still remains a bigger issue in our mind, which they have to fight with very strict policy. So if you look at the US, and what we do here is look at the US ISM manufacturing, which is, we believe, a good indicator of where the global cycle for developed markets are going. But we take the growth tax and we lead that by 12 months to give us a good indication of the pressures that's still in the economy. We can see that the at least in the US, that the manufacturing cycle is still facing some downside. This economic indicator looks at the dollar, oil, and 5-year interest rates. And from here, we also gathered that at some point it does look like we have seen a little bit of a easing of these pressures more recently. So that's why we think towards the end of the year, maybe things could start to look or improve for the US. In terms of inflation, inflation has run and peaked. It's in the process of turning around and coming down very quickly in most of the developed market space, but still at very, very high levels, so far above that 2% level where central banks want it to be. Whereas in China, you see there's no risk or no inflationary problem at the moment, which means that they have some scope, to potentially stimulate their economy more. So if we then go and see what the market is pricing and what the market believes, if you look at the black line and the green line, these are 10-year and 2-year break-even rates. That is essentially what the markets imply interest rates or inflation to be over the next 2 years or over the next 10 years. And what is interesting is that after a brief period where you saw the market pricing in more inflation, if you look at the black line, the market now says that the 2-year inflation and the 10-year inflation outlook remains relatively the same, and it comes down to about that 2% level. So the market essentially puts a lot of confidence in the Fed's and central bank's abilities to bring inflation back down to where we are at the or to 2%. Whereas the experience in mainstream has been a lot different. We've seen inflation ratcheting up to close to 10%. It is coming down, but as I said, as a result that there's a lot of stickiness in some of these metrics, which I'll go through in a second. We think that at least on a cyclical basis, it will remain sticky. But over the long term, we're facing a much different world over the next couple of decades than we've seen over the last few decades, in that we're facing deglobalization, onshoring, demographics that's changing, where there's more people retiring, so more consumers relative to those actually being able to produce in the workforce, which is inflationary. We potentially see also less savings, higher investments, which will require higher interest rates to balance that out. And so overall, we think that inflation will remain a bigger long-term problem than we have seen over the last couple of years. One of the key things that we look at is looking at the Atlanta Fed. They break down different inflation components into the flexible components and the sticky components. Now, the sticky components is about 70% of core CPI. And if you look at this chart here, you will see what has been coming down, both on a 12-month basis and on a 3-month annualized basis, are the flexible components. So these are more related towards goods, whereas on the sticky side are more related towards services. So services inflation hasn't really come down as much yet. Over a 3-month annualized basis, we're still sitting at 5%, and on a 12-month basis, we're still rising. So we think that this view that inflation will come down quickly to 2%, there will be some risks there that the market will have to absorb at some point this year. Nevertheless, the market also believes that we will see rate cuts as inflation comes down. There will be cuts. So if you look at this green line here, you will see this is what the market believes interest rates will be by the end of 2024, so end of next year, that we will see Fed rates back at 3% from a current rate of about just below 5%. And remember, we are still expected to see a couple more hikes by the Fed, so to above 5%. So from there, we will see a significant amount of cuts. That's what the market believes. We think that that due to those inflationary pressures, we won't see this magnitude of cuts taking place in the market. And again, it will bring some volatility to the market to price out this green line to go back to that, to say the black line or the orange line. It will take some adjustment and volatility in the market to price out these potential cuts, because that is what the market has been railing on, I guess, for the last few months. When we look at the labor market, which we believe is a key input into our view for why inflation will remain higher than what central banks want it to be, is that the labor market remains extremely tight. If you look at the orange line there, you will see the amount of job openings in the economy, which is about 11 million. But there's only about 5.76 million people that are looking for jobs. So there's about a gap of 5.3 million of job openings that needs to be filled. So this means that this job market remains very, very tight. And where we in the central bank believed that we will see this orange line coming down towards the black line, and so closing that gap, we've seen the last few prints has also been quite sticky. There are some structural changes in the labor market that is causing inflation to remain, or causing the labor market to remain very tight, and therefore it puts upward pressure on wages. So the good news, however, is that from a consumer perspective, we have seen nominal wages rise. So due to these tight labor market dynamics, you're sitting at 6% at the moment. But as inflation starts to come down from those very high levels, the real wages are starting to rise. So in real terms, people are starting to become better off again. And we think that this will provide some support to the consumer, and hence we're calling for a shallow recession rather than a deep recession. When we look at Europe, and this has been, I think, one of the key events of the last few months, is that energy prices have come down quite significantly. Energy prices in the form of oil as well as nat gas, and that has eased a lot of pressure that has been on the European consumer, and that therefore sentiment has improved around Europe. So you can see here, sentiment indicators in Europe has picked up from very low levels, but to the extent now that we think that Europe, whereas last year we thought Europe will be, we had a weaker outlook in Europe than for the US, we now think Europe is actually looking slightly better than the US. And we also see some flows coming out of the US flowing into Europe. And we're seeing that from a policy perspective, also Europe hasn't done as much or hasn't hiked as much as the US just yet. So they're not facing the extreme tightening that the US is facing just yet. And so we think that with China also opening up and providing, or the demanding goods from other markets, and Europe being a very open market, they will benefit from increased demand in China. So Europe isn't strong. It's still going to grow at roughly close to 0%, but it looks better than the US. In the last region, China. So I think this has been the second biggest, I think, event of the last few months, is the reopening of China. And you can see with that how the markets has responded. Currency has appreciated. Hang Seng is up about 50%. Metals has responded. If you look at the current COVID cases in China, that's come all the way down again. So they're through their wave. The economy is reopening up. And so I think it's very valid, and for the market to now really look and see whether we're actually going to see the data starting to confirm this reopening that has picked up or that has taken place. And so we will wait until, I guess, over the next 6 weeks. So until March, we'll get the first real data points, hard data points starting to come through to show how this reopening has impacted the market. So we could expect, a little bit of uncertainty until we actually get the data coming through. But it hasn't been just the reopening that's taken place. It's also that after the 20th Party Congress last year, that a lot of the policies which the authorities had in place for the last 18 months has become unsustainable. It has put too much pressure on the economy, and you can see a list of some of those policies, whether it was the zero COVID policy or restrictions on the property market or the tech crackdown, or just question marks about what the actual economic ideology is. A lot of those things actually has been answered post the conference last year. And we've seen a U-turn made by Xi and his leadership to ease up some of these restrictions. So not just on the health front, but also on tech, also on property. And the reason for that is to bring forward, again, some social stability, because remember, they faced some protests toward the end of last year. So we think this is at least a cyclical boost to China that would last from the short to medium term, which we continue to monitor, but could be a key driver this year. With that, what we see is that households that weren't able to spend during the pandemic, their savings has gone up quite substantially. And also because they've lost confidence in the property sector, they haven't really levered themselves up. In fact, they've delevered themselves. So the balance sheet's also looking a lot better. And with this pent up savings, we think that we could filter through the market over the next few quarters and provide a decent amount of spending boost to the to not only the Chinese economy, but also to the open economies like Europe and emerging markets around the world. Lastly, if you focus on South Africa, what's happening here. So typically, when we see an improved environment, external environment, like we see at the moment for China reopening and commodities doing better, South Africa typically benefits from those in the form of our terms of trade. So the black line shows the terms of trade, meaning that the prices of goods that we export rise more than the price of goods which we import. And you can see typically what happened then as well is that the rand also appreciates in that environment. Apart from this last episode, we haven't seen that appreciation. In fact, if you look at this orange line and the 5-year history, then against or the 5-year history, we're actually trading at a decent discount. So the rand is actually quite cheap at the moment. And the reason for that is that although the external environment has improved, the local environment has certainly deteriorated. In that we're sitting with not only pressure on the consumer, but also a lack of energy, which curbs our own investment or our own growth potential in the country at the moment. If we look at what has happened over the last year and where we're sitting at the moment, this is the amount of hours that we've seen in terms of load shedding. So the SARB estimate that in Q4 last year, the hit to growth in the last quarter was about 2% on an annualized basis. So you can see it's a significant hit to growth, in particular to small businesses, and corporates. It hits their profit margins, increased costs as well. I don't know if you've seen the headline, but apparently Shoprite, for instance, is paying something like 100 million rands a month in additional just for the generators to keep them going. So this is definitely impacting also corporates in their profitabilities, but also on the on the agricultural side, what we're seeing is that many produce are dependent on irrigation, and with reduced irrigation, there are some concerns about not necessarily food scarcity, but the supply chain of food coming through, and that could also provide some risk to food inflation in the future. So we are watching these things, but recognize that this is putting a lot more pressure on the consumer. So what's been done about this? And we'll get obviously a lot of information from the SONA later this week. But this is the National Energy Crisis Committee's path, which they believe they can implement. Now, just for 2023, if you look at some of those plans, like for instance, Kusile, where about 3,000 megawatts is expected to come online this year, Eskom themselves have said that those units will only be online sometime next year, so in the first half of next year. So I think the 2023 plan to have in place around 8,000 megawatts by the end of this year is very optimistic and most likely, not achievable. The other thing here is if you look at the imports from neighboring countries, where they expect another 1,600 megawatts to come through, a lot of that is dependent on restarting new plants in Mozambique. So there's reliability issues there as well. So again, a very optimistic plan. But if we get half or a third of this coming through this year, it will take us from stage 4-6 maybe back to stage 3 to 4. But to get through the whole load shedding process, which we are exposed to at the moment, I think we'll have to get to the end of next year at best. So what it means is that the next election will be run on I think the fate of Eskom, and that will obviously make for some interesting moments. Right, so if you look at the consumer in South Africa, this is retail sales in real terms. So look at volume. Then you'll see that the consumers also face some pressures. Households have not spent as much as they've done in the past. And this is really as a result of these tighter conditions around food, fuel, higher interest rates, and also higher employment. The one area which I think we can see some relaxation and easing that will benefit the consumer maybe later this year into next year is when the central bank starts to cut interest rates. So we can see that inflation is coming down. It's expected to fall within that band sometime later this year, around the middle of this year, and then towards the 4.5% sometime next year. And also what you see is the central banks typically, once the CPI rate has fallen below the policy rate, it stops to hike interest rates. So we expect maybe another 25 basis points by the SARB. After that, maybe a prolonged pause, but then potentially cuts from late this year, beginning of next year. So I guess support for the consumer potentially only coming through sometime next year. And that means that we remain quite cautious on SA Inc. So we remain cautious in SA Inc., but we do acknowledge that valuations are cheap. If you look at SA MSCI versus emerging markets, we remain at least one standard deviation cheap. So we are looking at opportunities in this market, but we are more reliant on external revenues. Overall, this is how we think about the world. As a result of this divergence in growth between the US and the rest of the world, we think that the dollar will continue to weaken. We think that commodities will be supported by an improved outlook in China, a weaker US dollar, and still a lack of supply for a lot of these commodities. We prefer emerging markets, both equities and bonds, especially those markets that can cut rates, and that is more linked to China. And then on the bond side, we like both SA bonds and global government bonds. We like global government bonds as a hedge against potential recession. And we are most cautious on US equities within a global construct. We think that some of their earnings are still elevated, and in a recession scenario, that will have to come down. And so we like South African equities above those, and within SA, we like those names that has got the offshore earnings potential relative to the SA Inc. portion. So that was my comments around the global situation or the macro outlook. I can quickly talk you through around our positioning. So just maybe 30 seconds on this slide. We are still underweight equities relative to bonds and commodities. So we try to have a more diversified portfolio. But within equities, we are only neutral South Africa. We're looking to be opportunistic there. And when we see value, we'll go overweight. But at this stage, we remain fairly cautious and only neutral with the underweight in global equities. In terms of our returns, it has been since we took over the fund in November 2020, strong performance since inception. Also had decent performance year to date, 7.2%. But as I said, to some clients the other day, I don't think that the start of this year is necessarily a reflection of the rest of the year is going to be. There's a lot of risks out there, and which warrants some caution. In terms of then how the balance fund is structured and where performance has come from, you can see that performance has come from predominantly from our equity strategies. So SA equity has outperformed each benchmark. Global and EM has also outperformed their benchmarks, although last year they were both down. And our allocation towards global fixed income in rand terms and also commodities in rand terms has benefited us last year. So overall, strong security selection with some enhancement coming from asset allocation. Hey, Gene, I think that's all I had time for. I don't know if there's any questions.
Yeah, Cobus, that was absolutely perfect. I've got one or two very quick questions from you, and thank you for the presentation. The one question is always about the rand, and I mean, you've showed a slide on the currency, and we all know that once inflation rates normalize, so US going back to their target rates of 2. You also indicated it might be a while from now, so it's not going to happen overnight. And SA goes back to, let's assume, 4.5 over the next 2 to 3 years. We know that our currency will weaken over time, but in the short term for 2023, do you think that the dollar will lose a bit of steam, or are we going to see that flight to safety again?
Yeah, I think the dollar will remain on the back foot for the main part of this year, mainly because of global growth ex-US starting to look better in the US, and the US potentially starting to pause before the ECB does. So pressure would remain on the dollar in that environment. You would think that EM currency should do better. So that's why SA is undervalued where they are at the moment. But it's really the local dynamics that is not working for us, and we're seeing Eskom playing out. That could still have an impact on the fiscal side of the economy. So there are some local risks which pushes me to be more cautious on the rand, and not yet just bet for that the rand will appreciate. In that environment, even if we think the rand will start to appreciate from these very undervalued levels, you want to allocate more towards global, I guess. That's what we're looking for. But at this stage, we think the rand is going to face some more downside. So sorry, we actually, in this environment, when the rand is strong, we want to put more towards global to take advantage of the rand weakening.
Yeah, maybe at current levels, not exactly the right time, but we'll see how things play out. Maybe just one last question from my side. We often tell our clients and our audience that, they must understand, doesn't matter how negative you are about the South African economy, there's still some very good companies or shares on the JSE where the majority of the earnings comes from international markets. Can you maybe make mention of one company that you guys are excited about and that you are including in your equity carve-out in the balance fund?
Yeah, look, I'm a fixed income guy, so I'm not going to talk too much about specific names, but I think where we think there are some opportunities, those sectors and names that's exposed towards the reopening of China, and towards the still the inflationary theme. So energy stocks, well, today Sasol is not a great example, but it's not luckily the only energy stock that's out there. But we think that the energy complex could still provide some opportunity. So maybe now is a good entry point. And within resources, we still like the miners. We still like the diversified miners. We still like the PGMs, even gold. So we continue to see value in those names, although we have taken some profits on the platinum side.
Jacobus, thank you very much for that. We are very much out of time. To our audience out there, I can maybe just very briefly on the NMS portfolios. In the income portfolio, our average yield is sitting at about 9.5%. We also include some global credit, which has done extremely well for us over the past couple of months, also managed by Fairtree. So that's part of a very well diversified income portfolio. And we share our views with Fairtree. We remain a bit more cautious. We do think 2023 is going to come with a lot of other challenges. So don't take what happened in January as the expectation for the rest of the year. So we are very cautious. We are looking for those opportunities again by deploying managers or employing managers like Fairtree Asset Management. We remain optimistic. We are taking care of your portfolios. We're very actively looking at these things, and we do try to find the best fund managers out there for you, like Fairtree. Jacobus from the Nesher management team side, thank you so much. From my side, thank you for your time, and we hope to speak to you soon again in the near future. Keep on doing the good work you're doing. To our lovely audience out there, clients of Nesher Management Services, thank you for your continued support. If you have any questions with regards to the session or the portfolios, please don't hesitate to make contact with Hercules or Megan, Charlene, or Harvey. Thank you. And that's my story. Thanks, Jacobus.
Thank you, Gene. Thank you, everyone.